Welcome, dear traders. After a choppy session, the main stock indexes were able to recover and close to the day with gains. Asian stock markets resumed growth as well, entering positive territory. Watch our video review and find out the latest market news. Let's start. Wall Street collapsed following an unexpected 0.1% increase in the US CPI Index. Analysts had widely expected a decline, so investors rushed to sell off shares, and trading charts of stocks, which were vertically diving down, clearly illustrated traders' bitter disappointment. However, the equity market managed to regain ground. Besides, the market reaction to the producer price index was not so sharp. The report showed a decline for the second month in a row, although the PPI Index indicates that US inflation is indeed slowing down. Some indexes are still rising. In August, the CPI Index added 0.1%, remaining at the June level of 0.4%. So, core inflation, which has perked at 6.5% over the past 3 months, is still very far from the Fed's 2% target. This is why speculators are factoring in at least a 75 basis point increase at the Fed meeting next week. There is also a likelihood of a 100 basis point rate hike. According to CME Fed Watch, it totals 22%. Fed funds futures are pricing in a 37% chance. On a Wednesday, Filch, one of the leading think tanks, slashed the global GDP growth. It expects the world GDP to grow by 0.5% to 2.4% in 2022. Fitch analysts attributed their pessimism to the fact that in recent months the global economy has been facing a perfect storm, namely the EU energy crisis, sharp rate increases by major central banks, soaring inflation, and the recession risks. Apart from that, they highlighted the crisis in China's real estate sector and the country's economic downturn. Therefore, aggressive tightening by the Fed may adversely affect other central banks and their national currencies. After the Fed switched to monetary tightening, central banks faced a choice. They could watch the weakening of their national currencies or make some efforts to boost them. To do so, they should either sell dollars or raise key rates. However, it poses certain risks to the economies. The US dollar is largely up thanks to expectations of aggressive rate hikes. It also jumped considerably following a downbeat inflation report. Today, it's trading near its 20-year high, moving in the upward channel of 109.58 and 109.92. In the Asian session, its upward movement weakened and the price slid into the sideways channel. The greenback was hovering near the 109.64. The next resistance level may be located at a high of 110.79. And the support level is seen at 107.43 and 106.93. Analysts point out that demand for the greenback is likely to remain high in the long term amid its safe haven status. Given the hawkish stance, its rally is sure to persist. Over the year, the US currency has climbed by 15% versus its rivals, remaining an undisputed leader on forex. The US dollar scored the biggest gain of 25% versus the yen. The latter has become the main outsider due to the fact that the Bank of Japan sticks to an ultra-loose stance and keeps Japanese bond yields near zero. So the yen may finally regain ground only if the Fed starts cutting rates or the Bank of Japan begins to raise them. Besides, a strong dollar is a real calamity for Asian markets, as many commodities, especially crude oil, are converted in dollars. For the reason, import costs are soaring due to weak currencies. Yesterday, the Bank of Japan made verbal interventions. However, it did not take any action, although there were rumors that the Bank of Japan urged the banks to report on their exchange rates. According to the media, the Bank of Japan was extremely concerned by a fall in the yen to 144.90. It appears that the regulator has set the crucial level of 145. If the yen breaks through this level, the regulator may enter in. Today, the dollar-yen pair is hovering significantly below this critical level, trading at 143.45. However, given the bullish bias of the US dollar, the pair may approach the critical level, moving in the intraday range of 142.77 and 143.77. So, the Australian and the New Zealand dollars advanced amid fresh economic reports. Australia's employment recovered after a fall a month earlier. And in New Zealand's second quarter GDP topped the forecast reading of 0.1%. The figure rose by 1.7%. An upbeat labour market report increased the likelihood of a 50 basis point rate hike by the Reserve Bank of Australia. However, the next meeting will be held only in October, and this is why the outlook of the Aussie remains bearish. Today, the AUD USD pair is trading at 0.6746. However, yesterday's low of 0.6705 was located higher than the previous lows of 0.6699 and 0.6681. All three levels are above the pivot level of 0.6670. Hence, the Aussie may find support in the area of 0.6670 and 0.6705. In the Asian session, the pair was moving in the price corridor of 0.6740 and 0.6771. The Reserve Bank of New Zealand may also raise the key rate by 50 basis points, given the positive GDP report. However, the next meeting will take place only on October 5. The Kiwi is also losing drivers for further growth. However, in the Asian session, the NZD USD pair was trading in the upward channel near 0.6003. It's now moving from the support level of 0.5996 to the resistance level of 0.6027. And that's all for now. Subscribe to our channel and stay up to date with the latest market news. Feel free to leave your comments down below and see you soon.